is the CEO of the SME Finance Forum, IFC World Bank Group. So I'm sure he'll have another interesting take on this topic.
Hi. So as you heard, I'm Matt Gamser, and despite the accent, I'm not here representing America. I work for a part of the World Bank Group, the International Finance Corporation, which is the private sector arm of the World Bank. We're owned by 184 countries, not one. It's not my first forum here. I wear two caps because I spend most of my time now running an enterprise, because it's not a distinct legal entity, for the G20 countries, which we manage on behalf of IFC, and that's where the SME Finance Forum comes in. And we're basically a center for knowledge exchange and networking promotion, since I've described it in earlier meetings, even if some of you weren't there before. Suffice it to say, I'm the marriage broker and the cheerleader for the finance industry to do a better job of financing SMEs. And I mean finance, and I don't mean credit, and I don't mean just banks. We represent the broadest possible picture. And fintechs and fintech play a very important role. So I was trying to think of what to say. I didn't know who would come and how many might have been here last year or the year before when I've talked on these topics here. So let me just start by figuring out who I've got in the room. Raise your hand if you're an entrepreneur. And these are not exclusive answers. Raise your hand if you're an angel. Okay, raise your hand if you're government, if any agency, public sector employee of any sort. There's not a value judgment here. I just want to know who I'm dealing with, because I want to speak in a language that's understandable. Let me briefly summarize some things I tried to point out in previous years, because my focus is on, I want to focus on small business and technology, and why technology is important both for small businesses and for the financing of small businesses, and financial technology in particular. So what the big finance sector will never tell you is they hate SMEs, but they do. And they always have. And there's a very distinct reason for this, because the way conventional financial technology and approaches have evolved, whether it's in banks, whether it's in capital markets, whether it's in insurance companies, you name it, you can heavily automate and deal with consumers. And with the big kids on the block, the corporates, you can spend a lot of person time. And because they're big and they're doing big deals with you, you can afford it. And this whole mass in the middle that's accounting for most of the jobs in all your countries, most of the innovation, all the essential goods and services for the average person, unfortunately, it doesn't work for them. You can't completely automate, and you couldn't. And there are two other problems. That this same sector has historically, even today, except maybe in Sweden and Denmark, but certainly still in the UK, still in Saudi Arabia, where it just was, still in quite well-to-do countries, is doing most of its business in cash, and it's doing its deals on paper. So this makes it even harder to figure out how to do things. Or it did, because I didn't come here to tell you a bad news story, because the digitalization story you heard from Scandinavia is becoming the digitalization story of everywhere. How many of you in the room know that Africa has the highest incidence of regular adult use of mobile phone-based financial products of any continent on the planet? There's one person, more than 20% of adults in Africa. China is not a continent. It has a higher number. Asia has a lower number than Africa. And that's because technology is enabling there not to have to be a continuum. I was always behind, I'll always be behind. No, technology is enabling what we call leapfrogging to happen. And as people move from going cash in payments to going digital, and they're not going digital primarily to credit cards, or debit cards. They're going digital right to the smartphone, which is now available for $30, $35 just about everywhere in the world. And with the Wi-Fi, WiMAX, soon to be 5G infrastructure, it's enabling all sorts of things to happen. And things to be transformed right down to the level of the dukkha in East Africa, the sari sari shop in Southeast Asia, you name it. Now, the second thing that's happening is and here we have to go into distributed ledger and blockchain. The contracting process, which is on paper and requires things like that are called notary publics and things who are, this all dates back to 14th century Venice, by the way, and it's basically unchanged, except it now can be changed. And we can use digital procedures to verify agreements, and even through the Internet of Things to monitor the movement of what the agreements are about, and monitor everything in real time, along with those payments, which we're also seeing in real time, not waiting for audited accounts or waiting for a business plan, which is still what, by the time you get it, even if it's right, it's telling you about something that was too long ago to be useful for you anymore. So all that is changing. And as you might expect, it's not the biggest commercial banks or the largest insurance companies that are at the forefront of doing this, because they're the big kids on the block. They've been doing the best. Why would they have the most incentive to be out front of the new change? But there are an increasing number, including regulated commercial banks, regulated insurance companies. I don't want to name names because I don't know who's in the audience and I don't want to get in trouble. But it's and of course the fintech sector is coming from the other side. Although, 5 years ago when I started the network, everybody was talking about competition, who's going to win. Jamie Dimon made the quote, "The fintechs are coming and they're going to kill us all," or whatever he actually said. And we said at our first meeting when we brought actual bankers and fintechs together for real, we said, it's all going to be about partnership, and that's what everybody's talking about today. And that's where it could go. And so we're moving from the analog to the digital, from the paper to the smart contracts. And we're just starting to see where this could go. And the reason it hasn't happened sooner, and fintech's been talked about, because of course initially a lot of the investment in fintech, for what everything in finance does first, go for the upper 1%, go for the wealth management, the robo-advisors, the high-speed trading, things where even if fintech works well, which in some cases it might, and in some cases it doesn't, the improvement is so marginal. But now we're finally seeing people moving into space like this small business market. And let's go to angels as my final thought here. What's the biggest problem of angels? Because with all due respect to NASDAQ, angels serve orders of magnitude more businesses each year than the NASDAQ does, 600, and that's a very tiny fraction of businesses. They're very well served when they can make it to NASDAQ. But angels are the ones that are going to get them there. And the trouble is angels are all disconnected. And a lot of angels have a bad experience initially and they never are an angel again. So angels are also analog. But angels, we're increasingly seeing, can use this same technology to go digital. And to go digital both in terms of how they organize with themselves and also how to be real-time in touch with your clients, with your investments, without having to physically be there, which has been the only way you could really be on top before. So this gives all sorts of potential. And the final word on this, because I couldn't agree more that this whole area of environmental and social governance or ESG, is really, really important. And that's why the World Bank Group in Bali, with people like BlackRock and many of the exchanges, published the impact investing principles, because unfortunately, everybody calls themselves an impact investor nowadays because there's more and more money chasing impact investments, but very few people, there's no meaning to the definition. So we've tried to make a start by getting the large investors together and say, okay, what can we say here? And what fintech's going to enable us to do is, because what we've been able to say is, look, at least if you claim your impact, you have to then say, what is your impact and how are you measuring it? We couldn't get to the point of saying, well, impact in environment means X for everybody, or social means Y, or governance means Z, but at least we could agree that you have to publish. And then that's where technology comes in, because that's going to be what's going to enable you to show that you're really in touch. That same sort of distributed ledger immutable technology is going to, and the Internet of Things is going to enable the verification of this. And it's in principle going to enable the verification not just for the very, very large investments, but for everybody. Because while SMEs are small, and therefore no one SME is causing a major environmental issue or social issue or governance issue, you put them all together, it actually adds up to potentially a lot. And so we need to find ways to reach our ESG measurement and ESG monitoring right down. And FinTech's going to do that for us too. It's going to do it, and it's going to enable the next generation NASDAQ, because I don't want to be misinterpreted as attacking NASDAQ, because you're going to see, instead of 600, it's going to be 60,000 or 600,000, because you're going to enable even more expedited processes where the information can flow directly, and where you can be an investor that just wants to put 100 euros into some investments, and you're going to be able to have, without all the intermediaries, you're going to be able to do those deals. So that's the prospect I want to throw out at the end, and happy to address any questions and discussion.
Thank you very much. Yes, we'll have you a bit later to maybe participate in some stuff. Thank you very much.